6 Ways to Valuing a Company, Part 2 of 2. 4. Comparable company analysis involves comparing a company's financial metrics, such as revenue and earnings, to those of similar publicly traded companies. The valuation is based on the average of the multiples of these metrics across the comparable companies. To use this method, you simply would need to identify a group of companies that are similar to the company being valued in terms of size, industry, growth prospects, and other relevant factors. This can be done by researching industry reports and financial news websites. Then you would collect financial data for the comparable companies, including their market capitalization, price-to-earnings ratio, enterprise value to EBITDA ratio, and other relevant metrics. Followed by calculating the multiples for each metric by dividing the metric for each comparable company by its revenue or EBITDA. Next, would be to apply the multiples to the company being valued by multiplying its revenue or EBITDA by each multiple. This will result in a range of values for the company based on the different multiples. Followed by determining a valuation range for the company being valued by taking an average of the values calculated in step. Finally, adjust the valuation range based on any differences between the company being valued and the comparable companies, such as differences in size, growth prospects, and risk profile. It's important to note that comparable company analysis is just one method of valuing a company and should be used in combination with other methods. Additionally, comparable company analysis can be influenced by many factors, including market trends, industry dynamics, and macroeconomic factors, so it's important to consider these factors when interpreting the results of the analysis. 5. The asset-based valuation involves valuing a company based on the value of its assets, including tangible and intangible assets, minus its liabilities. The first step in asset-based valuation is determining the book value of the company's assets by looking at its balance sheet. This includes tangible assets, such as property, plant, and equipment, and intangible assets, such as patents and trademarks. Then adjust for the book value of the assets for their fair market value, which may differ from their book value. This can be done by estimating the current value of the assets based on market conditions and recent transactions. Next, you would determine the value of the company's liabilities by looking at its balance sheet. This includes both short-term liabilities, such as accounts payable and taxes owed, and long-term liabilities, such as loans and bonds. Then you need to calculate the net asset value by subtracting the total liabilities from the fair market value of the assets. This represents the amount that would be left over if the company were to liquidate its assets and pay off its liabilities. The final step is to adjust the net asset value for any intangible assets that are not reflected in the balance sheet, such as brand value or customer relationships. 6. The enterprise value to EBITDA method divides a company's enterprise value, market capitalization plus debt minus cash, by its earnings before interest, taxes, depreciation, and amortization EBITDA to determine the multiple of EBITDA that investors are willing to pay for the company. This method is a popular valuation metric because it is used to evaluate a company's overall financial performance. To evaluate using the enterprise value to EBITDA, you would need to determine the company's enterprise value by adding its market capitalization, total debt, and preferred stock, and subtracting cash and cash equivalents. The next step is to determine the company's EBITDA, and you do this by adding its earnings before interest, taxes, depreciation, and amortization. The next step is to calculate the EBITDA multiple by dividing the company's enterprise value by its EBITDA to determine the enterprise value to EBITDA multiple. Second, compare the enterprise value to EBITDA multiple to the multiples of other companies in the same industry. If the company's multiple is higher than the industry average, it may be overvalued, while a lower multiple may indicate undervaluation. Thirdly, consider other factors that may influence the company's valuation, such as its growth prospects, competitive position, and overall financial health. It's important to note that enterprise value to EBITDA is just one method of valuing a company and should be used in combination with other methods. Additionally, enterprise value to EBITDA can be influenced by many factors, including market trends, industry dynamics, and macroeconomic factors, so it's important to consider these factors when interpreting the results of the analysis. Each of these methods has its advantages and disadvantages, and the appropriate method depends on the industry, the size of the company, and the purpose of the valuation. It's common to use a combination of these methods to arrive at a more accurate valuation. Use code BLOG to receive 25% on your next purchase. Thank you for watching.